Hello everyone. In today's Finance in 3 Minute series, I'll explain why the equity and crypto market is sensitive to interest rates. What are interest rates? RBI has many ways to dictate the money supply in our economy. One of the known instruments is interest rate. Repo rate is the rate at which Indian banks borrow money from the RBI. An increase in repo rate means an increase in the money supply. Here, instead of parking money with the RBI, the banks rather prefer to lend it out to general public, corporate entities, and such. Thus, increase in money circulation. And reverse repo is just the opposite. An increase in the reverse repo rate will decrease the money supply. When economy gets gloomy and dull, the central bank wants more economic activity and thus they tend to reduce the interest rates. This reduced interest rate will create a chain effect that ultimately reaches to the end consumer. For example, home loan, which was once serviceable at 8.5 to 10% interest rate before the pandemic, is now available under 7% rates. So, many people will come forward to take home loan. Similarly, auto loan, student loan, credit card debts, and such. When interest rates are reduced, people are promoted to spend more, thus revive the economy by their spending and consumption. Correlation between investment and interest rates. Interest rates and stock prices generally move in opposite directions. In principle, raising interest rates should make saving more appealing. If your bank saving and fixed deposit earns a fair rate of interest, it becomes more difficult to justify the additional risk associated with the investing. For example, when RBI raises interest rates, fixed deposit gives higher return, say 7%. In such cases, most investors prefer to park their funds in FD than to invest in equity market because investing is risky, right? So, when the interest rates are increased, risky assets such as equity and crypto market will take a hit because saving funds in the banks or investing in bonds are more favorable than taking an active participation in equity or crypto investing. Hence, people move out to their investments and tend to buy more bonds or save money in their banks. There's additional reasons for raising rates. In order to revive the economy, central banks reduced rates. As days goes by, the economy is up and running as usual. In such case, the currency value should increase. But with excess money in circulation, the money purchasing value tends to decrease. We call it inflation. Inflation is like a cancer to the economy. They kill wealth from inside. For practical example, look at Turkey and Pakistan. They make common people's life a living hell. In order to avoid such an economic mess, central banks mediate before such happening and raise interest rates and pull back the excess money like a sponge absorbs wet water from the floor before we slip. That's all about interest rates and its impact on equity and crypto market. Thank you for watching.